So what's causing this from your point of view in the markets? Is it that strong economy Mary Daly just talked about?
Well, I think there's a couple of things, David. Number one is you have to remember the Fed pivot rally that's been in place for the past 2 months has been pretty powerful, and it's been driven by a lot of multiple expansion. Specifically, since the end of October, multiples have driven about 87% of the S&P 500's run. But you've had a relatively good earnings season as well, right? So earnings estimates continue to kind of bottom out and hook back up. The U.S. seems to be leading the way in this charge. And it seems as though the market's digesting that the Federal Reserve may not cut or may not cut as much as they expect this year, and they're taking it pretty much in stride.
Well, that's one of the things I'm interested in, because where the market was on how many cuts and where it is today is quite different. They've cut it like in half the number of cuts, and yet the markets didn't seem to take that too adversely. Why is that?
Well, the bond market certainly did, right? Yes. So you had the bond, long-dated treasuries had backed up pretty significantly, but the equity market was pretty much able to power through it. And we think one of the reasons that this is the case is that many companies, U.S. companies specifically, large cap companies, have termed out their debt. So they don't have big refinancing risks coming up in 23, 24, 25. They're looking to later dates more like 2027 and 2028 before they have to worry about refinancing. And we think that's a big reason that the equity market can look through some of the noise of pricing and Fed cuts.
One of the concerns you hear a lot about is concentration in the equity markets, and particularly this magnificent seven, or however we count it. How concerned should we be about that concentration, that it's not broad enough in the equity markets?
Well, concentration is indeed going global. You see it in the U.S. markets, you see it in the international markets as well, specifically in Europe and also in Japan. In the U.S., though, I think there's a really interesting point to look at this. So if you go back to the dot-com period in the early 2000s, right, the top 5 companies, they had a net income margin of about 20%. Right? If you take a look at the top 5 companies in the S&P 500 this year, their margin is closer to 30 to 31%. I think you cannot strip out the operational dominance of these large companies and the high free cash flow that they are indeed throwing off every year. And I think when you take a look at it on a PE basis, no question, the market's expensive. But when you drill down on some of those other metrics, some of the froth starts to come out of it. And it's being supported by relatively strong earnings and relatively good free cash flow as well.
One of the things you hear about is valuation. I mean, does it make sense to buy more at these valuations? Because it seems to be a lot, what do they say, price to perfection?
Price to perfection is short. There's not many places that you can find great value at this point, along with improving fundamentals. But we do think that the U.S. is going to have another relatively strong year relative to the rest of the world. I know there's a lot of chatter going on in the markets right now about maybe buying Europe, maybe buying the emerging markets. China may do a big fiscal stimulus. We think that the relative valuation and the premium that the U.S. commands is for a relatively good reason. We're sticking closer to home. We're sticking in U.S. large cap stocks. If the Fed were to aggressively start cutting interest rates, it may make sense to go down in cap size. But right now, I think you're better off being in the U.S. And because the rest of the world isn't feeling particularly well, it's kind of a somewhat reminiscent of the mid-1990s. U.S. was doing well, rest of the world was on its back. Relative strength for the U.S. dollar is another one to consider as well when you're going global.
On its back, but Japan is not quite the way it was on its back as before. Is that sort of coming up a little bit? I hear some talk about Japan.
It only took 34 years for it to recapture its 1989 high, right? So, look, Japan is a really interesting market to us. I think that if you're going to go out to Japan, you have to hedge your currency back into U.S. dollars. Japan, because they've been through so much over the past really 3 decades, the market doesn't tend to respond much to recessions as you do, say, in the US or in Europe. But Germany right now is in a middling recession. Emerging markets don't feel particularly good. If I had to be any place, I'd probably stick in U.S. large caps.
U.S. large cap, not medium and small.
No, U.S. large.
Yeah, it's too hard to pick those stocks in the smalls and larges. It's practical.
You need a Fed rate cutting cycle to really get that smaller cap size of the market going.
One last quick one. What about terming out debt and fixed income? Because you might want to lock in some of these rates.
Look, we think that there's a lot of money sitting in money market funds at this point. Everyone says I can get 5% in money market funds. Why do I want to do anything else? Even if the Federal Reserve doesn't cut interest rates this year, 5% won't be there forever. There's a reason that cash is generally not part of an asset allocation portfolio. I would say that the most interesting piece right now to us looks like longer dated treasuries. We think that they're good insulation against an economic slowdown, and you're getting that positive real yield.